Welcome to this explainer. We're diving right into how the literal spare change in your pocket is revolutionizing personal finance for the everyday person. We hear a ton about Wall Street tycoons and massive stock portfolios, but today we're looking at a trend that's entirely about Main Street, specifically the coins rattling around at the bottom of your bag.
Okay, let's jump in. Imagine a 25-year-old barista juggling student loans and rent, with maybe just $5 left at the end of the week. Investing usually feels like a total pipe dream in that scenario, right? But what if those few dollars could build actual long-term wealth? That's the whole premise of micro-investing. It's a trending niche in fintech that's fundamentally democratizing wealth building for millions of people who honestly felt locked out of the market before.
And we really need to understand the environment that makes this so necessary. Look at this brutally honest 2021 Federal Reserve statistic. 36% of Americans couldn't even cover a $400 emergency expense. When you're living paycheck to paycheck, traditional investing isn't just intimidating, it's practically impossible. Micro-investing steps directly into that gap, giving us a way to build savings gradually. It's not just about the money, it's a huge boost of empowerment.
In today's explainer, we're going to cover the spare change revolution, exactly how micro-investing works, the pros and cons, a quick comparison of the popular apps, and finally, the future of finance.
Section 1. The Spare Change Revolution. So we're seeing a massive shift away from traditional investing, which, let's face it, usually requires thousands of dollars and complex market knowledge. Instead, we're moving toward micro-investing. This utilizes automated pocket change and offers an incredibly low barrier to entry. Back in the day, you needed serious capital to buy into the market. Now, these platforms break down those walls by letting you start with practically nothing. Over 10 million Americans are already using these apps, and that number is absolutely skyrocketing as younger generations prioritize financial literacy.
Section 2. How micro-investing works. Let's look at how this plays out. Meet Sarah. She's a freelance graphic designer, and every time she buys her morning coffee for $3.50, her app rounds that purchase up to the nearest dollar, so making it $4 flat. It then automatically takes that 50-cent difference and invests it into a diversified portfolio of ETFs, or exchange-traded funds, tailored to her personal risk tolerance. By the end of the month, she's invested $15 without even changing her behavior or noticing the money is gone. Pretty neat, right?
The crucial point here is that it all happens in 4 super simple steps. No need to stare at complex candlestick charts. You just sign up and link your everyday bank accounts. Then, you automate those roundups or set up recurring microdeposits, like say $1 a day. Your money flows straight into diversified portfolios. These ETFs spread your risk across hundreds of stocks or bonds, meaning if one company goes under, you won't get wiped out. Finally, you pay a nominal fee to the platform. It's essentially a set-it-and-forget-it approach to building good financial habits.
Section 3. The Pros and Cons.
Now, we have to talk about the catch, because fees can seriously drag you down. Take a look at this. A seemingly low $3 monthly fee on a $100 balance, that's actually a massive 36% annual cost. While these apps pride themselves on low monthly fees, usually between $1 and $5, when your total portfolio balance is super small, those flat fees eat up a huge chunk of your overall returns. It's a real hurdle, and one you have to outpace by investing more over time.
Beyond those fees, you've got to remember this definitely isn't a get-rich-quick scheme. You have limited control over picking individual stocks. Plus, your money is absolutely subject to market downturns, just like any other investment. And here's a big one. These accounts lack FDIC insurance. While platforms like Acorns and Stash are regulated by the SEC and insured by the SIPC to protect you if the brokerage itself fails, your money is not guaranteed against market losses the way a standard bank savings account would be.
Section 4. Comparing the popular apps.
When you're looking at your options, Acorns is fantastic for that roundup automation we just talked about. It's basically ideal for absolute beginners, and it starts at just $1 a month. Then there's Stash, which also starts at $1 but focuses heavily on financial education and lets you buy fractional shares, giving you a little more hands-on control. And of course, Robinhood. Now, while it's not strictly a micro-investing app, it does let you buy fractional slices of expensive stocks, commission-free, for as little as $1, though it completely lacks the automated roundup features of the other two.
Real stories of impact. Let's anchor all this with some real people. Take Jake, for example. His story shows how just $10 a month in roundups built a $500 portfolio over 2 years. Honestly, the dollar amount isn't even the magic part here. More importantly, it gave him the confidence to actually learn about investing and start saving for a down payment. It transformed him from a complete non-investor into someone actively planning his financial future.
Next up is Maria. She's a single mom who invested just $5 a week and built a $600 safety net. Once again, it's all about the psychological shift. She created a buffer for herself that literally didn't exist before. And even more powerfully, she's passing that crucial financial literacy down to her daughter. That's huge.
And then there's Ethan. He turned a $50 birthday gift into $80 using Robinhood's fractional tech shares. It just proves how a super low barrier to entry builds long-term saving habits. He admits he started out treating it like a game, but seeing that actual tangible progress made him take his monthly contribution seriously. So you see, these stories aren't about striking it rich overnight. They're about proving that tiny, consistent actions build incredible momentum.
Section 5. The future of finance.
The future of these apps looks incredibly dynamic. As the whole fintech space evolves, experts are predicting some wild innovation. We're talking AI-driven investment recommendations customized entirely to your own personal spending habits, seamless cryptocurrency integration for those looking to diversify even further, and much deeper gamification to make saving and investing feel genuinely fun and engaging.
But zooming out, the ultimate macroeconomic impact is just staggering. McKinsey actually estimates that digital financial tools could bring 1.6 billion unbanked people into the global financial system by 2030. In emerging markets where access to traditional banking is scarce, being able to invest small amounts right from a smartphone has the potential to empower millions of people to build wealth for the very first time.
Now, microinvesting isn't a replacement for a 401k, right? But it is a brilliant stepping stone. It's about starting exactly where you are, using the tools available, and watching what happens when you just let time and consistency do the heavy lifting. So after seeing how small pocket change can compound into massive global shifts, the only question left to ask yourself is, are you ready to grow your future $1 at a time?